I've just completed my most recent self-assessment and I discovered a tax allowance that I wasn't aware of in the past. And this tax allowance is for £5,000. So it could save you a fair old chunk of change on your self-assessment tax bill. So in this video, I'm going to talk you through my tax calculation and explain to you what has happened. Then I'm going to take you over to the government website and show the official stance so you guys can see it's not me making this up. This is genuine allowances that you probably aren't capitalizing on. And then at the end of the video, I'm going to link you to the most tax efficient way to pay yourself in tax year 2024, 2025 if you haven't seen that video yet. So as a director of a limited company, and this is also available to low income employees as well. It depends how much you earn overall, but as I go through this video, it will become clear. If you are a director of a limited company, the chances are you're paying yourself a basic income, which is usually making full use of your personal allowance. Then you're paying the rest of your income via dividends from the business. So you can see here in the previous tax year, I paid myself £12,570 as that was a personal allowance last year. That was the amount I could earn tax-free. Now, I also had another benefit from my company as I have a company car. So that is listed at £998. Now, you probably won't have that or you have it at a different value. The reason I wanted to include it in this video as it does impact the calculations that I'm going to show you later on in this video. So you have a £5,000 allowance, but for me, this takes off £998, only leaving me an allowance of £4,002. But that'll become clearer later on in the video. So what am I actually talking about? How are you going to save potentially over £1,000 on your self-assessment tax bill, or potentially over £2,000, depending on what tax bracket you fall into, by just making use of this allowance, which you probably aren't aware of. So there are two allowances you need to be aware of. The first one, which you probably have heard of, is your personal savings allowance. And the reason this is important is a lot of people think they have to save in an ISA, as an ISA is tax-free, whereas if you put your money in a standard easy access or fixed savings account and the bank pay out the interest to you, you're then supposed to declare that and pay whatever income tax band you are, so either 20% or 40% on that income. So what people do instead is they put the money in an ISA and you can put up to £20,000 in per year, and then each year you can add to that. So eventually after a few years you might have 100k in your ISA. The problem is often ISAs don't pay as high interest rate as other savings accounts. So sometimes it's not worth that saving to use the ISA because the other accounts are paying more than you'd lose through your income tax. So that is why people use ISAs in the first place. Now, a lot of people don't actually realize, but they have a personal allowance to start with, which is up to £1,000. So depending on how much you earn. Now, this is a savings allowance that some people are aware of, but there is another allowance, which is much bigger, that a lot more people aren't aware of, and this is your starting rate for savings. You may also get up to £5,000 of interest and not have to pay tax on it. This is your starting rate for savings. Now that is a huge amount. So say you've got 100 grand in the bank and you've got it in a 5% interest account. In that year, you're going to make £5,000. Now you're going to go straight over your £1,000 allowance or £500 or £0 allowance. But if you've got this starting rate allowance as well, you won't pay any tax on that £5,000 and you don't have to put it in an ISA either. This is where this allowance is so powerful. So why can you get this as a director of a limited company or a low earnings employee? Let me explain as we read through it. So you may also get up to £5,000 of interest and not have to pay tax on it. This is your starting rate for savings. The more you earn from other income, for example, your wages or pension, the less your starting rate for savings will be. If your income is £17,570 or more, then you won't be eligible for it. So basically, if you earn up to the personal allowance threshold, which is £12,570, you get your full £5,000 starting rate savings on top of the £1,000 personal savings allowance. You can have up to £6,000 of savings interest before you start paying tax on it. So if we go back to my self-assessment calculation, you can see how this has been applied to my income, because as many of you guys will know that at the moment I'm currently living in a rental property and my house equity is locked up in savings accounts. So over the past year, I've been earning a lot more from savings than I usually would have done in the past, as the money's in banks locked up in savings accounts rather than in my house as housing equity. So if we scroll down to the bottom here, you can see. So firstly, the £5,000 allowance. For me, they deduct £998 because my company car, my benefit in kind, is seen as income, whereas dividends aren't seen as income. So they're taxed separately. That's why dividends don't impact your overall income, and that's why as a director of a limited company, you can make full use of this £5,000 as you only earn £12,570, despite the fact how many dividends or how much in dividends you might be paying yourself. So they've deducted £998 from my allowance because I've got that as a benefit in kind. Otherwise, my starting rate here would have been £5,000. Instead, it's £4,002. So from my starting allowance, I still got £4,002 that I get basically tax-free for my savings interest. And then I've also got the additional £1,000 of savings allowance, the personal allowance, which I showed you on this page, the personal savings allowance at the basic rate of £1,000, because if you're paying yourself dividends, it helps to keep you down in that basic rate tax threshold bracket. And then you can see at the end, the rest of the money, so the additional interest over that starting savings and the personal allowance, which takes you up to £6,000, or in my case, £5,002, I then get taxed at the basic rate, which for me is 20%, as I pay the rest of the money via dividends. So I've paid 20% on the rest of that savings interest. So that allowance you guys need to be making full use of, as it will save you. If you think you've got another £5,000, if you're a 20% taxpayer, that is £1,000 you're going to save. And if you're in the higher rates, it's going to save you even more. And if you're a low income employee, maybe you're in early retirement, you've got lots of savings, you might not be making full use of this. So be aware, you may not have to use ISA to get it tax-free when you've got up to £6,000 of tax allowance. When you combine the £1,000 personal allowance and the £5,000 of starting rate for savings, you may be able to use any account you want, paying the best possible rates, rather than being restricted to only 20 grand into an ISA. Now, if you are a director of a limited company and you haven't seen my most recent way of how to pay yourself, the most tax effective way to pay yourself in 2024, 2025, I'm going to pop up a link to that video now, and I'll see you guys over there.